Hey there, I'm estate planning attorney Paul Rabalais, and in this video, I'm going to talk about how the new estate tax rules for 2021 may affect your family in the future. All right, so I don't know anybody who likes the idea of having to pay tax. I don't know anybody who likes the idea of having some of their estate go to the IRS when they pass away. And it's kind of a wonky time for the estate tax. The rules change every year. The rules might change significantly in 2021 if there is no new passage of law by Congress and the President. The rules will change significantly in 5 years. So let's talk about it and get it all straight. All right, so first let's just talk about what we know has happened with the gift and estate tax. So in 2020, the estate tax exemption, the amount that you can give or leave to your beneficiaries, to your heirs, to your survivors, without being subject to the gift or estate tax, the amount for 2020 was a whopping $11.58 million, and really double that for married couples who plan their estates appropriately. And every year for the past several years, that figure has just been increased slightly due to inflation. So the new figure for 2021, when somebody dies, they can leave now. It was 11.58 million. Now it's 11.7 million. So again, double that for the married couples as long as they set up their estate properly. So the married couples, in theory, can leave, $23.4 million estate to their survivors, and without incurring any of that, what is now 40% estate tax. So, what does that mean? That means this year with the new $11.7 million exemption, I'm going to have a bunch of conversations with people who aren't as smart as you because they didn't watch this video, and their conversation with me is going to sound something like this. Some hardworking American has a conversation with me, has busted his rear for probably 40 years working, may have even accumulated, an estate with their house paid off and with their retirement account and with other things that they have, may have accumulated $1 million, a couple of $1 million estate, and they come in and they're like, Mr. Rabalais, I'm talking to you because I need to set up my estate. I'm not getting any younger, and I want to make sure my estate don't have to pay none of that death tax, or they might call it the inheritance tax, or they might call it the estate tax. But the conversation goes something like, I've been paying tax my whole lifetime. Every year I pay tax. Every paycheck I got, I pay tax. And by golly, that ain't no way I'm gonna give some of my estate to the government when I die. I added it all up. It looks like it's about $1.5 million. And, by golly, if the government's going to take half of that when I die, you just, put together whatever you need to put together. I'll sign it, but I'm not going to pay that death tax. So, what they just told me is they have worked hard. They have about 1.5 million, and they have this expectation that their estate's going to be kind of walloped with an estate tax. So I'm just kind of cringing right now. I'm saying, oh God, here comes the conversation that I've had a million times. So the conversation goes, well, Mr. or Ms. So-and-so, we do have this estate tax, but it only applies if when you die, you have more than $11.7 million. And I can see the wheels turning in their head. They're like, then they usually say one of two things. They're like, well, I guess we don't have that problem there, or boy, that'd be a nice problem to have, or, at least we don't have to worry about that. So anyway, I'll have that conversation over and over, I'm sure, in 2021 with people who haven't watched this video. Okay, so that's it for that slight increase in the estate tax exemption. Next, let's go into the annual exclusion amount. That's how much you can give away each year without having any kind of estate tax or gift tax consequences. And it has been adjusted gradually over the years, increases in $1,000 increments, but doesn't increase each year, only when the inflation adjustments require it to be bumped up by $1,000. So last year was $15,000. This year in 2021, it's going to be $15,000. Everybody gets confused about the annual exclusion amount of $15,000. Let me just tell you real quick the way it works. Most people mistakenly believe that if they give away more than $15,000 to someone, somebody's going to pay some tax, but that's not the way it works. You can give $15,000 to as many people as you want to. If you give more, nobody owes any tax. You just start using some of your estate tax exemption. So for example, and I'm talking fast here because I've done it a million times, and I'm going to get you through it, and we're going to move on to some of the juicier stuff. If you were to give $115,000 away to somebody, you give it to them, you put it in trust for them, whatever the case may be, as long as you put it in trust for them the right way. $115,000, you made a gift. First $15,000, no gift tax consequences, but you made a $115,000 gift, so that's a $100,000 taxable gift. Who pays tax? Nobody, but you do have to file a gift tax return. No taxes paid with it. You have to show the IRS that you used $100,000 by making a $115,000 gift. You used $100,000 of your estate tax exclusion amount. So when you die, if you die in 2021, instead of being able to leave $11.7 million free of the 40% estate tax, you can only leave $11.6 million free of the estate tax because you used $100,000 of your exemption by making a gift of $115,000 to somebody. Okay, so now that we got that straight, let's kind of analyze things moving forward with what we know, what we think, what we hear, and put it all together. All right, so we know, I think we know that the exemption for 2021 for people who pass away in 2021, that exemption amount that's not subject to the 40% tax is $11.7 million. Could they change it mid-year? Maybe. More on that later. We also know that due to this Tax Cuts and Jobs Act that was passed years ago, even with no congressional or presidential action, the estate tax exemption gets cut in half on January 1st of 2026, 5 years from today. So we know that's coming, assuming there's no legislative action. We also know Joe Biden won the presidency. Look, let's not make this a political video. There's enough other places for that. Let's just, deal with the facts. We don't know who will control the Senate because that election is in 4 days. And even if I knew who was going to win, we still don't know what kind of effect that might have on the estate tax. We also know or hear or read that the President-elect Biden has proposed this $3.5 million exemption amount, so reduced from $11.7 million to $3.5 million. There's also word out there that Biden is proposing a $1 million cap on lifetime gifts, whereas now the $11.7 million, you can use it when you die, or you can use it during your lifetime by making very large gifts in excess of $15,000. And so the gift and estate tax is currently unified, and Biden's proposal apparently is to put the $1 million cap on the lifetime gifts. And we also read here that Biden is proposing to increase the estate tax rate if estate tax does apply from 40% to 45%. Put all that together. Right now, if somebody dies and they haven't used any of their estate tax exemption by making large gifts, they can leave an $11.7 million estate free of estate tax. However, under the Biden proposal, if someone leaves that same $11.7 million estate and we have a $3.5 million exemption with a 45% tax on the excess, then that person who died with $11.7 million, their estate is going to owe to the IRS within 9 months after their death, $3.69 million. Okay, so with all that being said, what do you do? And it's tough to know exactly what the answer is because there are a number of unknowns. A couple of those unknowns are, you don't know when you're going to die. Thank goodness we don't know. And then two, we don't know what the applicable law will be when you die. And then there's other factors that go into what action you take. How driven are you to actually take actions necessary that are to reduce tax? So for example, are you willing to part with your money by making these gifts either outright to your heirs or in trust for your heirs or beneficiaries? because you have to be willing to lose some control over what you have in order to reduce the assets that are in your estate subject to the estate tax. So those are all factors that play into this. But let's just look at a couple of examples. Let's say you have a really large estate, and I'm going to define that as kind of much larger than the $11.7 million. I mean, you're really doing well, and so what should you do? And I realize this is a very small fraction of the people watching this video, and I'm going to kind of get into the modest estates here in a minute. But I would say if you have a really large estate, you probably should have used your exemption amount last year with the 11.58 million, just gotten that out of your estate while the number was high, given that to your heirs, put it in trust for your heirs while you're alive, let that 11.58 million, or if you're married, 23 million plus, let that continue to grow outside of your estate so that maybe when you pass away, it's double or triple that, and you've passed that along to the next generation or two, estate tax free. But it's too late to do that because you're not watching this video in 2020, you're watching it in 2021 or beyond, so you're not able to do that. So since you can't do that, should you consider right now using your estate tax exemption in 2021? Well, you probably should consider it and make an informed decision, but we don't know it. I think it's unlikely that mid-year they would change the estate law and make it retroactive to gifts that took place when the law was different. So if somebody on January 1st of 2021 transferred their $11.7 million to their heirs, no taxes due under our current law, and then a new administration and a new Senate in July or some later date changes it and makes it retroactive back when somebody took some action when the laws were different, that just doesn't make sense to me, but there's just not that certainty there. We just don't know. Now, obviously, if you're the wealthy and you can afford to, and it fits within your philosophy, you ought to be maxing out on those lifetime gifts. So if you have 10 potential heirs between children and grandchildren, that's $10,000, $15,000 gifts. If you're married, that's $20,000, $15,000 gifts, $300,000 that you can just get out of your estate every year. You're not using any of your estate tax exemption. And again, those gifts, if invested properly, will continue to grow and you'll be saving significant sums of future estate tax, it's likely. So, all right, now if you have that modest estate, let's say you're in there's no hard and fast rules here, but that $4 million to $10 million estate, and many of you will think that's more than modest because it is more than modest, but from an estate tax planning perspective, we'll call that a modest estate. You really can't afford to make a large gift, in excess of $3.5 million to try to take advantage of a larger estate tax exemption now. Because if you have a $6 million estate and you give away $4 million of it, you're probably a little worried that you might run out of money. So you're not able to make that large gift, but you should consider, again, maxing out your annual gifting if you're in that $4 to $10 million range, because it's looking like there's likely going to be an estate tax hit on your estate. And if you wait too long to start doing the annual gifting, then you're not going to be able to gift it fast enough to reduce it because your estate is likely appreciating in value and you just don't have enough people to give it to be able to reduce the estate below whatever that applicable estate tax exemption, $3.5 million or whatever it might be. So you may want to start planning ahead now. Again, you only do the gifting if it fits within, if it feels right, that you don't want to give money to people who don't know how to handle it. We have trust for that. You don't want to give away money that makes you less than secure that you have enough money to live for the rest of your lifetime. So there's some non-tax reasons to either gift or not gift that have to be factored in. And I would say if you're in that modest range, or really anybody, because there's so much uncertainty in the future, you just need to have all of your estate planning documentation, whether that's through your wills or through your living trust, set up so that the flexibility is there when you pass away to make decisions based on whatever the laws and rules are at that time. So for example, if you're married, you want to make sure your estate planning documents are set up to take advantage of something that we call the estate tax unlimited marital deduction. It virtually guarantees that a married couple can arrange things so when the first spouse dies, regardless of the size of the estate, there's no estate tax due. And that's by taking advantage of leaving things to your spouse, leaving things in a certain trust for the benefit of your spouse. You want to make sure you do all of that. Second, you want to make sure your estate is set up to take advantage of what I call a portability, or what is called a portability election. So for example, if you're married and the exemption is $3.5 million and the first spouse dies and they're only using $2.5 million of their $3.5 million exemption, there was $1 million that they didn't use, and with the proper post-death portability election on an estate tax return, the surviving spouse will have their own estate tax exemption, plus they'll be able to add to that the $1 million portion of the exemption that the first spouse to die didn't use. Okay, so that's a quick overview of where we are, where we might be heading. There's another important point here. It's this Secure Act thing, because even though the Secure Act is not necessarily estate tax related, it's very income tax related, it has estate tax ramifications, because what the Secure Act did, and again, that was put in place at the very end of 2019, but it's affecting anyone who owns an IRA who died on or after January 1st of 2020. And it has some major estate tax ramifications. What it really does is it puts a big kink in the armor of those folks who have most of their money in their traditional IRA, and they have two goals. Their two kind of long-term estate planning goals are: one, minimize tax, and two, provide that conditions be put on the next couple of generations so that the estate can last and benefit people for many, 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 many decades to come. Can't do it anymore. Can't accomplish both of those goals if most of your money is in your traditional IRA, because the income taxes, if they're left for non-spouses, generally the income tax has to be distributed out and paid within 10 years after your death. There is the possibility for you to have those distributions payable to a trust and have that trust last for decades and decades and decades, where those distributions are accumulated in a trust. However, when you do that, you're not accomplishing your goal of minimizing income tax, because now the trust has to pay the income tax on that distribution at much higher trust income tax rates. Okay, so there we have it. About 80% or 90% of this discussion was all about the estate tax. Threw in that Secure Act and income tax that has an impact on people wanting to structure their estate to benefit their survivors for many, many years to come. Hope this was helpful. Make sure you click the like, all the usual stuff. Click the like button, subscribe, comment below. I'm going to play around with a video next time about if you have a hypothetical $100 million estate, what do you do with it from an estate planning perspective? I'm kind of looking forward to that. It's just one of those fun things I could do. And we'll see you next time.